Social Security is a major source of retirement income for many people here in the United States. However, more and more of them are having to give back more and more of those benefits. In this video, I want to share with you what is happening so you can better understand and not be surprised as you head into retirement with regards to how much you can really expect from Social Security. But before we get there, subscribe to my channel. I have over 30 years experience in this business, expert in retirement and Social Security, and I want to share those insights with you and make sure that you hit our notifications bell so you're alerted to when we post new videos. Social Security is one of those topics that is just so important to get a handle on as you transition into retirement. Yet so few people understand the complexity of it. Not a lot of advisors truly understand all of the 567 different strategies that are out there, which leaves many to rely upon Social Security Administration personnel for advice. That's not always the best answer because those folks really, by law, are not allowed to give you advanced strategy suggestions. They can tell you what the numbers are today, but in terms of picking and choosing all of those strategies, that's not their job. United Income did a study a while ago. They showed that Americans were leaving trillions on the table by making the wrong decision. And their conclusion was that 96% of people were choosing Social Security at the wrong age. It didn't mean that you had to wait all the way to 70. That wasn't their conclusion. Just that the vast majority of people are making that decision at the wrong time. So let's review what's happening, because the last thing you want is a surprise income reduction that you were not aware of as you now enter into retirement. Believe it or not, currently about 1/2 of all Social Security recipients are paying some portion of their benefits back to Social Security. And the number of people are expected to get higher along with the proportion of benefits they are expected to receive. This is a 40-year-old law. It's basically a means test. Back in 1983, under the Reagan administration, the first implementation of this mean testing was put in, where upwards of 50% of your Social Security benefits could be taxed. And then 10 years later, another layer was added to that, where upwards of 85% of your Social Security benefits could be taxed. Now, as I say, for many, this is a surprise. And what's really a surprise is the way that this was all constructed, because there was no inflation adjustment. Let's take a look at the chart for a moment. So going back to 1983, these were the numbers. And there is a concept called provisional income. Your adjusted gross income plus 1/2 of your Social Security benefit plus any tax-exempt interest, typically municipal bond income, is your provisional income. And if you are filing jointly and married, under $32,000, there's no Social Security benefit subject to tax. But if it's over $44,000, which it is for the majority of folks, up to 85% of your Social Security benefit could be taxed. And if you're single, that number was, in 1983, $34,000. Now, the interesting part about this is these numbers are still the numbers today, 40 years later. So what this has meant, as I just mentioned, is that a small percentage of people who were going to be taxed back in 1983 is now a lot larger. And the expectation is that upwards of 11% of your benefits will be given back as a result of this means testing. There are 3 things that you can consider, though. But before I get there, I want to share with you, up in our banner, I have a free chapter of my most recent book, Don't Outlive Your Money in Retirement. It's devoted exclusively to Social Security. Click on that banner, you'll get the free chapter. It'll give you a little bit more clarity with regards to what you should and should not be doing with regards to what and when you should collect your Social Security. Now, the first thing you might consider is contributing to or converting to a Roth IRA. Now, why is this important? And I've talked about Roth IRAs in other videos. Take a look. But there's 2 important components here. First and foremost, any of the income coming out of the Roth account is tax-free. So it doesn't come into play with regards to the provisional income. Also, assuming you're on Medicare and you've got the IRMA to consider, which is how much income you are declaring and therefore how much premium you will have to pay on a year-over-year basis for your Medicare. If you're taking money out of your Roth account, it also doesn't impact the premiums because there's no impact and no income is shown with regards to your IRMA calculations. The second option is to consider potentially a qualified charitable distribution. Now, assuming you have a charitable intent, you could go about to take money out of your IRA and you could send it directly to the qualified charitable organization. In so doing, you're taking money out of your IRA, particularly if it was a required minimum distribution. If it is, typically you have to show it as income, and therefore there's an impact on your Social Security and potentially the taxes. But if you take, and you could do upwards of $100,000 per person in terms of making the distribution, it would come out and go directly to the qualified charitable organization and not show up as income on your part. The third option for you, and it's really just being aware of what we call the earnings limit. As you can see here, the annual earnings test for every $1 in benefits will be withheld for every $2 you earn over $19,560 in 2022, assuming you are taking your Social Security before your full retirement age and you work. So a story I have told over and over again is about a client of mine many years ago who wanted to take her grandkids to Disney. And she wanted to earn an extra $8,000. But as it turns out, when we did the math, she hit the perfect storm. She hit all the thresholds, and as it turned out, as we talked with her accountant, she was actually going to have to pay 78% back to the government of the $8,000 because she had hit these thresholds. So our recommendation to her was basically, let's find another way to fund this wonderful trip. But you should be aware of what the earnings limits are, assuming you're going to take Social Security while you're working before your full retirement age. So it's very important to be fully versed in Social Security.